Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, ready to go. All right, let's see how the markets are doing to start. What do we got? Charts. Okay, so we're coming back. We were going down a bit, but now we're coming back. We tested this line here, and now we're testing that line from below. And this is what you call the first resistance line for the move up for the day. You know, this is a pivot points on Thinkorswim. So that's your first line of resistance, and the Russell is over it, and the NASDAQ is below it, the S&P is on it, and the Dow is below it. So we really want to see the S&P right now, see if it confirms a move up. Oil not doing anything, gasoline not doing anything. I like the short on gasoline if it goes below 175. Natural gas, big move up, 279. Nikkei flat. The dollar topped out here just below 90. Silver coming back a bit with gold. There's coffee. Coffee's terrible. Coffee keeps going down and down and down. Oh, here's gold. And gold isn't moving like silver is. So gold's actually a good long here. Because if silver picks up and gold doesn't, you have to figure that gold's going to catch up a little bit. So right now, gold is way, way behind silver. And so then you want to see, now once you identify something weird like that, you want to go to a bigger chart and see. So you can either change the time frame on these, or, which I prefer, go to, in my case, FinViz, which is my favorite, if I can find it. Oh, here they are, FinViz. And then I look at the metals charts, and I look at the daily view, and I say, see? So I was saying silver is bumping up fast, but gold isn't. But gold is way ahead of silver on the daily view. Now, I say that based on the look of the chart. You have to verify that by doing the math. So 1240 to 1360 happens to be 120. So there's a 10% move in gold up to the top. What happened in silver? 1570 to 1750. Let me see. Well, that's more than 10%. So silver went up more than 10%. So silver was neck and neck with gold. Then it fell harder than gold did. Silver fell back from 1750 to 16, which is basically a 10% drop. Gold only fell 1360 to 1330 is I don't know, but it's like a 30% drop, a 20-something% drop. So, 20% retrace. Let's get that straight. It's a 2% drop. There you go. Or 2.5% drop, basically. In fact, I bet if you do the math, it's 2.5%. So here's a 2.5% pullback versus what's almost a 10% pullback, right? Because 170 minus that would bring you to a bit below here, down here. So you're talking about almost a 10%, basically a 10% pullback here, And so gold is, it pulled back less and recovered more than silver. So gold is already quite a bit ahead of silver. And that's why silver is now catching up. So that then does not mean automatically you should be getting gold, because gold is already much higher than silver. So if we did the math here, 1360 to 1330, it's 2.5%, I think. Let's see. So 30 divided by 1360, yeah, so 2.5, basically 2.5%. So now if we take silver at, it's really higher than 1750, obviously, but let's say 1750. So 1750 times 0.975 is 1706. Wow. So okay, so until silver is at 1706, it won't be caught up to gold. That's the bottom line. So it's quite a bit lower than gold and has a lot of catching up to do. Therefore, not surprising, silver's moving up faster than gold. Okay, but therefore also that means that there's no knee-jerk reason to jump on a gold long just because silver's moving up, because silver is way, way behind and needs to catch up. All right, it's never going to catch up if gold keeps going. If gold goes up every time silver goes up, then it'll never catch up. Catching up means it's going to outpace gold at some point. All right, where are we? I know I have a trade here. I have one short. Let's see on this thing. I picked up one at right about 1545, and now I want to add another one at 1550, or as close as we can get. So I'm watching these guys to see who's failing and who's succeeding. So I have if the S&P can't get over this line, then this is going to all fail. But I'm not in a, I don't have a great confirmation here. He's in between his lines. I would much rather get a couple more up here. But we'll see what happens. But as long as he's under, this thing is still weak. And 68.50 is where we wanted to short the NASDAQ, but we're nowhere near that. And we're not, we had a shot earlier to do it. I missed it myself. Here's 25.1. 25.2 is really a much better short for the Dow. So there's a lot more they can go up before they fail. So I'm not super anxious to add here. But again, you have to keep things in proportion. See, for me, I have 10 contracts usually short. So having one just means I'm looking at it, and having two means I'm starting to put up a position. I'm not even, really, I'd like my first one to average like 1547. So I have to get up to about 1550 to average 1547. So kind of wait and see. I mean, it's too boring to have one contract short for me. But whatever. We'll take a look and see what happens. I just wanted to get one in there so we can talk about it. I would feel much better about this short at 1650. I'm sorry, 68.50. But again, we don't have good signals. The best signal is the S&P, so we watch that and see what it does. All right, so I'll get back to it if we have to. Any questions so far? Let's see what people want to talk about. Is there a way to make the picture sharper? Not that I know of. I don't know what the controls are. I don't think it's anything on our end, because I'm actually kind of impressed with the quality when I look at the replays. But I don't know. I don't know the mechanics of this thing. All right, well, that's it for questions. Meanwhile, okay, don't forget the Fed. Somebody remind me that the Fed's at 1 o'clock. At 2 o'clock, sorry. So as it stands now, this is all very disappointing, but we'll see what happens. Moving on to, let's check our portfolios. I don't believe the long-term portfolio positions are updated, but the other ones are. I know all the other portfolios are up to date. The LTP, I think, has a couple of adjustments that haven't been put in yet. Meanwhile, it's freaking impressive. Even without the changes, we're up 11 point. Is that current? Let me try. I don't say it if it's not real. Wow. Oh, yeah, even better. So we're up 11.5% now, and it's only February. It's only whatever today is, February 21st. you know, you really can't ask to do more than 5% a month in a portfolio. It's kind of crazy to expect anything better than that. You know, we were down. You know, when the market was down, we were down, but we didn't go down more than like 5%, I think, in this portfolio. And the recovery is amazing. And not only that, though, but it's better than this because, well, let me see if I can find the update. Did we do it on Friday? Does anybody remember? I think it was Friday. I'll be real impressed if it was Thursday. I can't believe I would have gotten to it that fast. I know we didn't have many adjustments for the long-term portfolio, and none were urgent, so I put that one off compared to the other portfolio updates. So Control F, LTP. Oh, there it is. Okay. So 11 a.m. Friday. That's pretty good. Yeah, it takes me a long time to do these. So the long-term portfolio on Friday was at 525. Now it's at 557. So we're up $25,000 for the week, and we only just started. That's kind of crazy. So here's the update that we had. All the positions are essentially the same. In fact, I'm sorry, all these positions are identical. This is what the untouched portfolio has done. The adjustments we made were on SKT. We bought more of the stock for $22.50, and SKT is now, oh, where is it? Oh, it's going to be in the same place. It's $22.20, so that didn't do better. So the adjustment was we bought more of the stock for $22.25. It's the same price. And then we sold 20 of the calls for $4 to add to a position. So I'm sure that position is not doing worse. Harmony, how are they doing? We shut the position down. We just changed the position. We went with the 250 calls. Let's see, hang on a second. We went with the 250 calls at 240, and we sold, we bought 50 and we sold 20. Oh, very aggressive. Okay, so we went very aggressive on Harmony, HMNY. Let's see how they did. And they have not improved, but they haven't gotten worse either. This was Friday, so they're basically in the same place as they were when we made the call. So I really like them, and that's a good for a new position, of course. And see, so barely any changes. Oh, that was it? No. Really? Wow. Okay, no. So there were basically no changes. There was very little changes, and the positions we changed wouldn't have had much impact, and the positions we left alone are up another 5% in a couple of days. So that's pretty good. That it shows that we're very we're aggressively in position. These are great positions, and that they're going to make a ton of money if the market goes up. That's what we care about. Obviously, it doesn't take much for these guys to make a lot of money. And like I said last week, though, which is very important to understand when you have an option kind of portfolio like this, we sell. All of these are short premium. Okay? In our positions in general, notice that we buy 40 and we sell 60. We buy 15, we sell 15. We buy 10, we sell 20. We buy 30, we sell 50. We're selling a lot more premium than we buy. So when the VIX runs up on us like it did on the sell-off, it makes our portfolio look bad because the risk premium of each position goes up. And since we sold risk and the risk goes up, then the person who bought the risk gets a more valuable position. But it only has value if you cash it out for them. They don't have control. We're the ones that have control. So we don't. So when they have a high premium, we certainly don't cash them out. And that's why also we made very few changes. There weren't that many great changes to make. But it doesn't matter. And again, these are mostly 2-year positions. So, it's just a bump in the road along the way. Any kind of changes we had. So when we were down 5%, we made a few changes that were advantageous to us. And but now that we flattened out, as of Friday, there was only 2 other positions we wanted to change. But that's how your portfolio should be. You should be making, it should be balanced enough that when there's even in a crisis, you're just making a couple of minor adjustments. It's like just tilting the if you're surfing and you're on a wave and it changes a little bit, you should be able to just tilt a little bit. If you're a good surfer and you're well balanced, you just tilt it a little bit more this way, a little bit more that way, and you move with the wave. You don't try to change directions completely, because that's how you're going to wipe out. And you don't do that in a portfolio either. Your positions need to be ones that you're confident in. They shouldn't be gambles. Like these short put positions. These are all things we really would like to buy. Berkshire's at 203. We promised to buy it at 165. And not even 165, because we sold the puts for 10, so we're promising 155. Blackstone's at 35. We want to buy it for 30. Cake is 46. We said we buy it for 45, but again, it's 45 less 250, so 42.50. CBT is at 64. We promised to buy it for 65. That's aggressive. CLF is at 775. We promised to buy it for 10 less 360 is 640. CM is at 91. We promised to buy it for 95. Oh dear. So that's in the money. But we'd love to own CM for this much, and we sold the 450. So we're talking about $90.50. But we would absolutely love to begin a proper position on CM at this price, because it's a great bank. They pay a good dividend. So and so on and so on. So anyway, these are all just positions that if the stock gets cheaper, we'll buy it. And in fact, SKT did get cheaper, so we did buy it. This is the one we added position to. We turned into a full position. But all of these, our reaction when these things go bad on us, like CM right now, is not to get out of the position or do something wrong. Our reaction is going to be to buy a full position. It's really a tracker for us to say, when is it going to be time to buy these guys? I'd love to buy these guys if the stock gets cheaper. How do I know when it gets cheaper? When my put's 75%, when it's a 75% loss in my put, that's when the stock got cheaper for me. So let's say I were to buy 500 shares of CM. We started on 2.2. Okay, CM. All right, so we started on 2.2, and CM was way up here at $99. And we said at the time, you know what? I'd like to buy CM, but we're going to buy it. We'll sell the September 95 puts for $450, so our net entry would be 90.50. All right, so we promised to buy it if it comes down here. I mean, obviously somebody has to force us to buy it, or we could exercise it if we want to. But the point was, this is where we wanted to buy it. Now, so far, it's had a nice dip down to 90, and it held the 90 line so far. We're hoping it actually comes down lower. I mean, I don't give a crap about the put, but we're going to buy 500 shares. So the 500 shares we buy, if they're $7 lower than they were when we started the position, we're not making it, but you understand we're going to save $3,500 on our entry on just 500 positions times $7. So the fact that we quote lost on the put, that doesn't matter. It's completely dwarfed by the entry that we're making. Not only that, though, but we haven't lost anything on the put because our entry is 90.50. So we would buy, if we can, 500 shares here for $90 or less. Hopefully, we're going to buy them for $87. But we'll buy our 500 shares. We'll still have the put, but that just means we'll double down and we'll have 1,000 if we get assigned ever. And then we're going to sell some calls. And let's take a look at CM. And we'll look at realistically where we could be. Oops, here's my question box. I can't see. CM. So let's say they're at 92 now. So let's say we sold the $90 calls, $6. All right, probably $6.50, $6.30, something like that. So we sell those guys for $6.30. That means that we would buy, let's assume we buy at 90, and let's say these drop to 5, and we sell these guys for 5. So our net is 85, and we still have the short 95, but we got 450 for them. So we're basically going to be assigned again at 90. So we'll end up with 500 at net 85, and we may be assigned another 500 at net 90. So then we'd have 1,000 at 87.50. That's our worst case. So we don't mind that because these guys are a great stock. We'd like to own them long term, and they pay a great dividend. I think it's like 6%. Oh, it's 5%. Okay, so it's like a 5% dividend. So that's why we want to own this stock. We like it. It's good. And also very undervalued because the Canadian dollar is weak, and we expect the Canadian dollar to pick back up because in an inflationary environment, oil and metals will go up, and Canada is very big on oil and metals. So we look at the loonie over the long haul and see how far down it is. It's down 20 something, about 20% from here, while the dollar is up, but it's been in retreat. And Canada will come back if oil. Canada's a very resource economy. So if resources come back, if there's inflation, Canada's going to do well. So we like it. It's a hedge against inflation. Obviously, the Bank of Canada has lots of Canadian money. So it's kind of a play on Canadian currency as well as just being a good, solid dividend payer. And, of course, perfectly good for a new play because it's right where we need it. Of course, if I was starting it now, I'd probably sell the $90 puts. Let's see what those are. The 2020 $90, yeah, they're $5. So I would sell the $90 puts for $5. There's no need to sell the 95 as a new position. Anybody asking questions? Oh, people are asking questions. Look at this. When trading futures, do you ever recommend holding overnight? I don't recommend holding overnight. I do hold overnight. It's not for the faint of heart, and it's certainly not for people who can't afford to lose $5,000 and laugh it off. You know, you got to realize you can get really banged on the futures. They're very, very dangerous, and it so much depends on your risk tolerance. So, a lot of our guys are high net worth traders, and I'm a high net worth trader, and we've got lots of money. So it's honestly, it's like, I don't want to make light of it, but I mean, if I could play craps, and I'll start with like $1,000 or $2,000 playing craps as like my pot, right? But if I start winning and I have $5,000, I might end up with like a couple of $1,000s on the table while I'm playing. And you can lose that on a roll of the dice, like $2,000, poof, gone. Just one thing goes up sevens, they take everything away from you that's on the table. That's how the futures is. If that happens to me in craps, if it's my whole pot, first of all, it was because of risk management, I wouldn't do that. If it was my whole pot, I wouldn't have $2,000 on the table. If I happen to be up to $6,000, $7,000, and then I'll put $2,000 on the table for whatever reason, if it dictates it. But then if I lose that, I'll probably keep what I have left and walk away. But the point being, though, that you can at any moment lose this kind of money. Now, in the futures, it's very much the same thing. At any second, you can suddenly lose thousands of dollars. If that's going to impact your lifestyle, do not risk it. Okay, so for me, if I win $1,000, it just means I'm going to take all my friends out for sushi. It's not going to impact my lifestyle. If I lose $1,000, we'll probably go have a pizza and then do something cheap for the night. That's the only difference it's going to make in my lifestyle, whether I win or lose on a craps table or something like that, or the futures, frankly. You just don't want to get into money that matters. And so, leaving it overnight just drastically increases the chance that it could go very badly against you. You just got to watch it like a hawk, and until you get good at it and used to it, you got to know your risk tolerance is the most important thing. So that's why so I would never say I recommend holding anything overnight. Now, do I? Yeah, of course. I've got my coffee trade on. I almost always have a coffee trade on that I'm long on coffee. That's KC, the regular KCH8, this one, which is doing terribly lately. I also have natural gas NGV8 is another one I tend to hold long term. So like whenever coffee or natural gas get low in a channel, I'll buy them, and if they don't go my way, I'll just sit on them, and they could go up and down. But again, you have to understand, I've had natural gas contracts. I think last year, it was the last year, or the year before, I was down $40,000 on natural gas at some point. It came back, and I made $80,000, but at some point I was down $40,000. So how much conviction do you have? How much of a loss can you endure? So on and so forth. You know, I certainly don't recommend that kind of trading for people who don't have $1 million liquid that they can mess around with. So you have to really it's up to your own what you think you can afford. But and anyway, if you ever want to know what a contract can win or lose, just look at the weekly flow of a contract. On Thinkorswim, they have this futures trader, active trader. No, damn it, charts, flexible grid. That's it. Okay. Got the flexible grid, and so here's NGV8. Okay, so this is hourly. So if I look at natural gas and I say realistically, how much money can I make or lose overnight? Well, clearly on many, many days, it moves this far, you know, which is $2.99 to $2.95. So it moves a nickel. So a nickel is $500 a contract. It does that almost every day. It goes up or down $500 a contract. That's not abnormal at all. You move out to a 4-hour chart there, and then you see what a really bad day looks like, and you see, like, here's one from 285 to 275, 10 cents. So basically 10 cents is a really, really bad day for natural gas. Now 10 cents is $1,000 a contract. So there's no denying, if you go to sleep with a natural gas contract, you can see that you could very easily lose $1,000 a contract when you wake up. If that's something that you laugh off and would say, "Oh, I'm going to double down because I lost $1,000 a contract," and that seems really silly. If you have the conviction, and again, this is what I did when it happened to me. I had something horrifying happen. 3 years weekly chart. Let's see if we can find it. Can I see it? I'm confused by 16. Okay, when did it happen? It isn't this. That was bad too, though, wasn't it? It must have been this. It must have been this. I think it went down to here, like $3, and I went long because I thought it was going to bounce from 340. And I think that's what happened. Then it went down to 250. So I'm down 5,000 per contract. And I think I had 8 contracts, because here's what I did. I had a contract here, and it went down to here, and I doubled it. And it went down to here, and I doubled it. And it went down to here, and I doubled it again. So I went from 1 to 2 to 4 to 8. So here I am sitting with 8 contracts, and basically I have $40,000 loss. And if it dropped another 50 cents, I would lose another $40,000. But I just had the conviction to stick with that trade, and then it comes back all the way to 3. Actually, you know what? I'm sorry. I think I had 16 at that point. That's what happened. I think I actually went up to 16, because I know that I ended up making at least $40-something thousand. So I think it turned around from minus 40 to plus 40 or something like that. It was like an $80,000 gain after the bottom. But the point is, there was a certain point at which I said, you're either going to stop out or you're going to double down. And if I was playing, and that was like, if that was whether or not I could pay my mortgage or something like that, or whether my kids go to college, I would have to shut the trade down and take the loss. But because it was a manageable amount of money, even though $40,000 was a horrible amount to lose, because it was manageable for me, I was able to continue playing as I saw fit, which was to take it as a gift that it went down that low. And at the time I was banging the table on this. So you can't be unrealistic about what could happen. Even, like I said, you look back to see what the variances are, and you can see here that here you go, 296 to 280 is 15 cents. So you can say 15 cents would be a really bad couple of days, And you can go on that premise, but that doesn't mean that it won't get worse, because here's $3 to 270. There's 30 cents in 3 days. It's not that it can't happen. And the question is, if it happens, what do you plan to do about it? So for sure, on an overnight question, unless you're willing, unless you have conviction that a move against you would be completely wrong, and that it would have to be for a dumb reason. Like I had conviction all the way down here for June, September, October. I mean, I started here. So from October until March, I continued to have the conviction to keep playing the stupid thing long, because I was convinced this whole time down that this was a stupid move that would correct itself at some point. At what point, I had no idea, but it did eventually correct itself. Unless you have really hard conviction, you're willing to stick with the trade. And there's other factors too, because sticking with that trade makes it so you can't trade anything else. It shuts you down and puts your whole portfolio into one trade. That's a terrible idea too. So there's a lot of ways like overnights can get you in trouble. But what I'm saying is, if you say, oh yes, I have conviction that this is going to go higher from here. Where are we now? The 270 line. If you say I have conviction to 270, then you have to have a plan for what you're going to do if it drops 5% on you and 10% on you. So if it drops 30 cents to 240, what are you going to do? And and I know for sure if that happened to me on an overnight, I would double down, and then I would have 2 times at the average of 270 and 240, which is 255. And then if it dropped lower, I would say probably if I'm at 255, to get my average to 240, say 245, I would need it to go to 235. So if it hits 235, I would double down again. Then my average would be 245. And then 245, I'd be happy to sit on for a while and see, because I think that's just stupidly low for natural gas. So I would have the conviction to ride out a lot of damage from that point forward. Now, if it goes all the way to $2, I would double down again, because I think $2 is completely ridiculous. But I know what I would do, and I can calculate how much money I'm going to lose as I do it. So I know when I start, the minute I go to sleep here with one contract long at the minute I go to sleep here with one contract long at 270, I know that I'm willing to go 8 contracts long at 240 and be down 8 times 15, $12,000. I plan on that the minute I put my head on the pillow, that I could be down $12,000 on the position. And frankly, I love that, because I want to have a huge position when it's that low. I like that better than if I go up here and it makes $1,000 and I go, $1,000. If I go from 240 to $3, I'm going to make with 8 contracts, I'm going to make a fortune. I'm going to make $20,000. So I'd rather, if it goes low first, I'd rather have the pain first, because I don't expect that I always make a perfect entry. But that's the difference between a conviction play and just playing the futures on an intraday level, where you're really playing for those support lines and the bounce. And then with the support lines, what I'm looking for is a news play. So I'm looking for a reason that the market's going to turn at any particular point. Like here we are here. And this is my more conviction, where I'm going to say I'm going to short that, because I want to have a couple short. So now I have 2 short at 1547, at almost 1548. That was my goal. So now what's my next goal? My next goal is I want to be at 1550. How do I get to 1550? I have to have 2 more short at 1552. So when we're at 1552, that's when I want to make my next short. And I'll add 2 more. And right now I'm down $300. But I'm playing with conviction. I'm not playing stops. Now, here at 68.50, you can play with stops. And if we test it again, it hit it while we were talking. If it hits it again, I would play with stops, because the S&P still hasn't come up over their line. And the Dow is there's no reason, other than psychological, there's no technical reason for it to stop where it is. So the Dow's making a psychological stop. The S&P is making a technical stop. And I think both of these guys are too high. So I'm hoping if we can hit 68.50 here, I might get a chance to short them too. Now, That needs to be backed up, though. I don't know if there's news. Of course, the Fed. Now, the problem is the Fed is maybe a wild card. I don't want to go too crazy shorting because right now it seems people are hoping the Fed's going to have something in the minutes that gives them something to latch on to, that they're not going to be so quick to raise rates. I don't see that. I think it's going to be exactly what it is, which is that they're going to have 4 hikes this year. And there won't be a definite statement of that in the minutes, but you'll get the inkling of it. But I think the plan is to hike 4 times and see what happens, or hike at least 2 or 3 times and then see what happens. They're not going to not hike. There's no option on the table for them to not hike. And that's the only thing that would justify the markets plowing higher at the moment. So did I ever answer the question? I don't even know what the question was anymore. We'll see. All right. Trading futures recommend holding overnight. How or why do you choose to do a bull call spread versus a bull put spread? I almost never do a bull put spread. The bull put spread is something if you want to short something or if you want to hedge something and you want to do it long term, you don't want to pay a premium, because buying puts is bitching premium, which I hate to do. So usually I do a bull put spread just because I don't want to pay the premium on the put, and I'm going to sell the premium to somebody else. A bull call spread, on the other hand, well, it's not much different, but a bull call spread, I'm basically doing that in lieu of buying the stock. So in other words, Apple pays a 2% dividend, something like that, AAPL. So Apple pays a 2% dividend. It costs $173 a share. I think Apple is going to be at $200 in 2020 at least. All right. So I could buy the stock for $170, or I could buy 100 shares for $17,000. Okay. And I hope to make $25,000. Wait, I'm sorry. I hope to make $2,500 at 200. All right. So I'm tying up $17,000, and I hope to make $2,500. Or I could buy the 140 calls for $45, and I could sell the 200 calls for $15. So what do we say? 45 and 15. So now I'm paying net 30. I'm paying 45 and I'm selling for 15. And now I've got the 140 200 spread. So I have a $60 spread. I paid $30 for it. What's my net entry? My net entry is 140 plus 30, right? I paid $30 for the spread. My net entry is 170. How much is Apple now? 173. So I got a $3 discount. I still make every penny of the upside to $200. But my return on the cash is going to be 100% back on the cash. I've only laid out $30,000 instead of $3,000. If you use the example of 100 units. For one contract, I've laid out $3,000 instead of $17,000. So I have $14,000 I can do something else with. And I'm going to make the same $3,000. I'm actually making more money. He's only going to make $2,500. I'm going to make $3,000 if we get to 200. Now, over 200, it's better for the guy who owns the stock and leaves it naked. But I wouldn't do that anyway. It's a terrible way to play, because you can lose, and then what do you got? So there's basically no downside to the bull call spread compared to the stock. In fact, they're in many ways it's superior. It's superior because you're tying up less cash. It's superior because on the way down, if Apple drops $20, you won't lose $20. You might only lose $10. So you lose half as much on the way down. You make just as much on the way up, and you use 3,000 instead of 17,000 is 14. I don't know. You use 80% less cash. Where's the downside? The only downside is the imaginary money that you wish you would make above 200, which is a ridiculous way to play. You should be thrilled that you make it at 200. If it hits where you think it's going to hit, you're going to make a lot of money. The only thing you're going to regret, and this happens all the time. This is why people stop playing options. They play it like that, and then one time or two times, some stock, instead of stopping at 200, it goes to 220, and they're like, "Oh man, I could have made $2,000 more if I had only not done this." But meanwhile, the 14,000 you had sitting on the sidelines would have made $2,000 in interest, just to put in a little a 4% return thing. So it's a ridiculous thing to say that you would be better off. So that's why a bull call spread, there's a million reasons I do a bull call spread. A bull put spread is almost always just because I want to short something, but I don't want to pay the premium for shorting it, so I offset it by selling the put. But it's generally not, because I more often will regret the fact that I didn't leave the short open, because some of those things tend to really crash out. Do you have concerns and doubts on GE? Is there an opportunity cost on the position? Do you still have the same conviction? Same for CHK, although they may have a bankruptcy risk. Well, I think first of all, they're both long-term slow motion turnarounds. GE particularly is going to take years to get back in shape, but I expect to own GE for 20 years, and I expect them to pay me dividends for 20 years. I expect them to pay my children dividends for 20 years, and it's in my particular kind of investing. I'm 55 now. I'll be 55 in a month. In my particular investing outlook, I'm almost anything I buy, I'm buying for my children. So, you know, and I don't expect my children, I know them already. I mean, they're teenagers, my girls. Neither one is likely to follow my footsteps. So they're not going to be traders. And that means the kind of stocks I really want them to have in the portfolio I leave to them are going to be good, solid dividend paying stocks like GE. So what I would like is for them to have I don't want them to have $1 million. I want them to have $1 million worth of GE that pays them $50,000 a year in dividends, but also will continue to expand with the economy, build with inflation, and keep paying higher and higher amounts of dividends over time. That's what I want for my kids. I want them to have like little annuity checks that they cash while the GE becomes a nest egg that sits in their portfolio. So I want their portfolio to be filled with stocks like that, not risky things and not short-term things. So I see GE as a fantastic opportunity now to buy a company that is very likely to still be here 100 years from now. The only thing that GE is doing is restructuring themselves. It's a massive, massive company that is changing their direction, changing their focus in planning for the next decade or 2 decades of growth. And I have enough confidence in the management and what they're doing, and I like where they're focusing, which is energy, biotech, and something else. Damn it, I always do that. Energy, biotech, it's healthcare, energy, and aircraft, right? Aerospace. So they're still in aerospace. They're still in, and then they're doing the energy infrastructure projects, which includes renewables, obviously, and then healthcare. So what do you disagree with about that? Do you think that healthcare is not a good thing to pursue for the next 100 years? Do you think that energy is not a good thing to focus on for the next 100 years? Is aerospace not a thing that we're going to be into? So they're focusing on 3 things I like to be in. I think my children should be in. And it's just a turnaround time right now. They're restructuring. So everybody's attacking them. They might even get thrown out of the Dow, which is even better, frankly. If they get thrown out of the Dow and they go to 12, that'll be, or 10, I'll be buying them like crazy. Because people are going to be forced to sell them. There'll be a lot of funds that are forced to sell GE if they get out of the Dow. Now, CHK, look, they're natural gas play, and I did a thing recently for the members. I don't know where it is, but there was a chart for natural gas that showed this year particularly. Well, here, I'll find it. This is an important chart you guys should know about. LNG. US LNG exports. Thank you. All right, hang on. There you go. Here's a good chart. See if we can make it bigger. No, can't make it bigger. Open a new tab. No, that didn't help. Control plus. Okay, there you go. Now, so here you go. This is the EIA. Not that I trust them, but there's many charts say the same thing, and plus our observations show the same thing. This is 2016. We're past that. We're in 2017, 2018. We're about here. So by the end of this year, we're going to be from here to here on exports. And in 2020, we'll be about here. Wait. No, 2020 is up here. So 2 years from now, we're going to be here. So that's trillions of cubic feet exported. So essentially what this means is we're going to be about, by the end of this year, we're going to be exporting about 1/3 of our natural gas production. And here we're exporting about half of our natural gas production. And here we're exporting 2/3 of our current natural gas production. Now we need, I would say probably we need about we need 2/3 of our natural gas production now. We can't export 2/3 without producing more natural gas. So who does that benefit? Benefits the people who are producing natural gas, even the ones who are marginally producing it, like Chesapeake. The price will go up for sure, and their production will be required. More production will be required from their current fields. So they'll produce more at a higher price. So how is that not a winner? All right. Why is Chesapeake in debt? Why do they have cash flow problems? Because they bet the farm on this happening. And why? Because they live this life. This is what they live and breathe. And when this was happening for the last 10 years, see here to here and all the way to here, they were buying and borrowing and buying and borrowing and doing whatever they could to make sure that they have a huge amount of natural gas reserves that they can drill when this happens, because they want to be one of the guys who has all the natural gas to produce. So, at this stage right now, and by the way, and what happens is all the fund managers who have their pet reporters, they'll sit there and they'll do what we call a jackal attack. They will send out their news jackals and they will make statements, and they will get their friends on CNBC and whatever to make statements, and they will diss your companies right and left, because what they want to do is buy them. They don't want you in them. You're a freaking retail trader. They don't want you to have to own Southwestern Energy, and they don't want you to own Chesapeake when this thing takes off. They want you to dump it here at the bottom, and they want to use, and they'll say anything they can negative. They'll spin negative reports. They'll have their friends at Morgan Stanley put out negative notes on the thing, because it's all meant to chase you out of it. They don't want you in it. You're taking up space. They could have those shares. That's what they do. They chase the retailers out of stocks that they want, and they do it by using the tools that you rely on to get information. They put articles in Forbes. You have no idea how easy it is to put an article in Forbes. I'm so tempted to demonstrate this, because it's like I would get so completely blackballed in this industry. But I'm telling you that if I want an article on Forbes that says black is white, I can have one printed like next week. It's not hard. There are so many writers there that you can just pay, you can take them out to dinner and they'll write whatever you want. You don't have to pay them. And that goes for most publications, though. Writers are very poorly paid, and and also they're treated like crap. So they have no loyalty to their publication. They don't feel like they're journalists. These publications hire more and more stringers. I just had 2 people from India, from Reuters today, interviewed me about Lending Club, which is a complete piece of crap stock, and they were trying desperately to put a positive spin on Lending Club today. Why? Because somebody paid them. Maybe not paid them, but somebody paid somebody to say nice things about Lending Club, even though they just turned in a crappy quarter. And I don't know how Lending Club's doing today, but I could not in good conscience tell them anything nice about Lending Club. They asked me for something nice, down 6%. They asked me to say something nice about it, and I said, no, it's a terrible stock. This is not an opportunity. This is a exposure of a disaster. This is a penny stock that's valued at $1.6 billion. It's ridiculous. But anyway, so not to get into that. But the point is, these were guys from India calling up, trying to get a story, but the story they've already been told what kind of story it's supposed to be. Their job is just to get quotes from people who tell them what fits the story that they want to write. You got to be so careful what you read. You have to be such a critical reader when you're looking at these articles, and think about what the motivation is for these things. And you got to learn to value things for yourself. You can't go by, oh, the chart looks bad, or the people said this, or Kramer's the biggest crook on the planet. You can't go by what these people say, because they've got agendas. And almost all these people have agendas. That's why I don't take advertising money. I don't want to be in this treadmill that these guys are in. They're all beholden to their advertisers. Little advertising we do have, if you're on PhilStockWorld for free. Let me see if I can do this. Open up in a incognito window. If you're a cheapskate reader and you're on PhilStockWorld for free, there are ads. See, there's one for Ameritrade. They're like a #1 advertiser. But I have in the past, here's a parabolic SAR strategy. I don't even know what that is. It's just like, I think they're Google ads or something. I don't think we really control what they are. Except, Fidelity, though, is Fidelity and it sponsors us straight. But the little ads like this is just whatever Google puts in there. Anyway, so I've had people threaten to pull ads from us in the past, even these stupid little ads. They say, I won't be able to advertise on you anymore if you keep saying this. It's like, screw you. But you can't do that if you're a site's beholden to advertisers. Then you suddenly have to say, oh, well, gee, I better think twice before I do this, or I better think twice before I say that. And even that little thing is so such a disservice to your readers, because you're like, you're prejudicing your viewpoint and you're letting them think something you're not. Like Nabob the other day was talking about inflation, and look, my view of inflation, and the reason I got in an argument with him about it was because my view of inflation, which I think is very important, is that we're going to have a lot of inflation down the road. He doesn't believe that. He thinks it's not going to happen. I was just making the point that I don't want anybody on this site to get the impression that I do not strongly believe that he's completely wrong, because his impression, I think, is going to cost people a lot of money. I might be wrong, but that's my impression. I'm not going to change it for anybody. And I don't want to have any pressure from outside who's telling me that's not something we want people to read about. Because banks will tell you they don't want people to think there's a lot of inflation. They don't want people investing that way. You've got to be careful about what you read. And even on a site like mine, you're still going to read contrary opinions back and forth, and you've got to make a decision on what's actually happening. So I just laid out my case and said, this is why I think we're going to have inflation. And it's a very simple case. I think that a ton of money has been printed. The velocity of money is very low at the moment. But when the velocity of money picks up, all that money that's laying around that's been printed and has been going nowhere, because, the amount of money in the world has been tripled since 2008. The amount of money that's flowing out in the wild, the cash that's in people's hands. But the velocity of that money is very low, because people are not buying houses, people aren't borrowing to do things, people aren't spending a ton of money they don't have, people aren't taking second mortgages and going on vacation with that money. People learned their lesson kind of on that. So the velocity of the money has gone to a very low level. So you can triple something, but if you triple the amount and cut the velocity of the amount by 1/3, you've done nothing. All you've done is maintain the status quo, and that's all the central banks have done. They keep printing money to make it so that we don't have a negative, so that the money doesn't contract. So it's the amount of money times the velocity of money is the net amount of money in the economy. They don't want the economy to contract, so they have to keep. If the velocity isn't going anywhere, they have to keep printing money. But the danger of that, though, is that now that they've printed all this money, God forbid the velocity starts picking up, they've got no way to stop it. It's going to get out of control really quickly. And what starts the velocity of money going? Wage increases. Oh, do we have wage increases? This is where we got in an argument. He says, no, there's been no real wage increases, because when you look at wages minus inflation, blah, blah, blah. Yeah, that's true, but that doesn't matter to inflation. Inflation is going to be what it is. And when you start taking the money supply that's out there and handing it to people at the bottom 90% minimum wage earners who are going to spend it right away, that starts a transaction where they give it to somebody who's also low on the totem pole. That person then turns it over to someone low on the totem pole, and it averages 3.1 times. Every dollar you give to a poor person will have a 3.1 times multiplier in the economy. Every dollar you give to a rich person, you're lucky if you get 1.2 out of it. So no, you give a dollar to a rich person, they'll probably give it to one other person. Very unlikely they'll give it to a person, and that person's probably a banker where the money dies, where it just sits, a banker, a broker, whatever. So there's very little velocity to money you give a rich person, because they put it into its final resting place where it's held and basically just accumulates at that point. In fact, not only does it accumulate, but it sucks up other money, right? It demands interest. So you give money to a rich person, they put it in a bank, the money demands interest. Not only is the money not moving, no velocity, but it's sucking up other money, charging interest. So it has a negative velocity. That's why giving money to rich people is a terrible, terrible idea. You want to boost your economy, you give money to poor people, they spend it. And then the people they give it to are still poor, they spend it. And the guy they give it to is a poor guy, he spends it. And by the third time, maybe you hit somebody in the middle class, and they then benefit too. And then finally, it goes into the hands of a rich guy who puts it in the bank. So it's the same. Either way, the rich guy gets some money. He just has to wait longer when you start it by giving it to a poor person. So I don't even understand why the rich people are against giving money to poor people. They get it anyway. all roads lead to the rich people. Anyhow, so that's my premise. It's basically that as these minimum wages start going up, and they're all ramping up gradually. Only 15 states or something have it out of 50 states have increased minimum wages. It's going to be 25 next year. It'll start spreading after that. Possibly there'll be also, though, once people start getting minimum wage increases, then the people in the regular workers look at the middle wage guys, like you've got the cleaning staff, right? So the cleaning staff suddenly is making $15 an hour, and now suddenly the secretaries who make $14 an hour, or I'm sorry, they were making $20 an hour when the cleaning guys were making 10. They talk to the cleaning guys. The upper management doesn't understand this. The rich people don't get this because rich people don't talk to the cleaning people ever. Whereas the people sitting there at the desk, the bulk of your employees who are typing crap all day long, they do talk to the cleaning people, and they know that the cleaning people got a 50% raise because the minimum wage went up. And then they start going, hey, wait a minute, why aren't I getting a 50% raise? Why am I still working for $20 when he got a 50% raise? And that's how wages start really rising, because the minimum wage creates a base that's high enough that people who are working other jobs complain. And if they complain enough and they don't like it, especially when there's low unemployment, they threaten to leave and work somewhere else, which will pay them more money, because everybody needs workers. So people start breaking down and paying more money. But it's a slow process. Obviously, if you look at a graph today, it's not going to show it today. It's going to take years to kick in, but it's going to kick in. It's going to slowly but surely drastically change, and it's going to really ramp up the economy, which is a good reason long term to be bullish on stocks, because whether justified or not, inflation, drives up stock prices. So, because it doesn't matter that the earnings are the same in percentage. The earnings are more in total dollars. Therefore, your stock price goes up in total dollars, which is really all you care about in the market. That's your measuring stick. So, where were we? What time is it? Oh, my God, it's bedtime already. Do you manage other people's money for the long-term portfolio? Yes, we have a hedge fund. So if you're rich enough, you can give us your money. But if you're poor, I'm sorry, we do not do that. So as long as you have the net worth that people need to be in a hedge fund, we do have a hedge fund. Can you show on the calculator how you calculate your potential profit on some of your trades? We were just talking about the one it was a $30 spread. I'm sorry, it was a $60 spread from 240 to 300 is a $60 spread on Apple, and it costs $30 to be in the spread. Therefore, if it hits 200, your potential profit is $30. It's not complicated. That's all we're doing. And anyway, time for the Fed. So let me put my sound on my TV. I'm cheating, so I'll let the TV tell us what's going on. And we'll take a look at the minutes when we have a chance. Oh, where are the stocks? Nope, no change here. Never hit 50. Never got over that. Oh, barely over that line. We're right at the line still. So this is for the January meeting. We're getting the minutes now. Where's the minutes? Damn it. Oh well. TV says upward trajectory for rates would be appropriate. No kidding. Stronger economic growth than forecast. See, there's nothing here about that would lend you to believe that they should be loosening rates. Why can't I get the minutes? Transcripts and other historical things? Minutes? Damn it. Minutes, current. Used to be like right here. It'd say statement and minutes. They expect economic growth to continue. Here we go. No, March 2007. Come on, don't be stupid. Advanced search. From January, whatever this year is, 2018 through February 2018. Search. Wait. Minutes. Nothing like that. I can't believe this. This is definitely where it always was. All right, sorry guys, I don't know why this isn't showing up. But anyway, so generally, they don't see a growth effect from the tax cut. That's funny. Okay, anyway, anybody got any helpful information about the Fed? Let's see. Go to forexlive.com. Okay, thank you. Highlights from the minutes. Okay, great, thanks. So it looks like the market's up a bit, which means I can do my other shorts. Because I don't see anything really particularly to make me think this should be flying up like this. Oh, I didn't get to. Oh, I missed it. My goal was 552 plus. Oh, here we go. Okay, let's try. There's one more. All right, see, so now I'm at my goal. I've got 1550, and I'm down $445. So that's my goal on that one. My goal wasn't to be down, but that's where it is. So now I'm at 1554 short, which I feel pretty comfortable with. Well, he popped up a lot, the S&P. So the question is, are they interpreting this correctly? Am I wrong? Maybe I'm wrong. So we'll see. Let's take a look at these minutes and see what it says. Labor market has continued to strengthen. Economic activity has been rising. Gains on employment, household spending, and business have been solid. Unemployment rate stayed low on a 12-month basis. Overall inflation and food and energy has continued to run below 2%. Now, the Fed needs 2% to really tighten. They don't like it below 2% inflation. Market-based measures of inflation have increased in recent months, but remain low. Survey-based measures, expectations, a little change. So they're not seeing any kind of big change in inflation so far. The committee expects that further gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace, labor conditions will remain strong, inflation expected to move up and stabilize at their thing. So they're saying that with the planned increases in rates, they see that all their goals are going to be hit. Near-term risk appear to be roughly balanced, but the committee is monitoring. In view of expected labor market conditions, the committee, okay, that's basically their statement. That's not the minutes. Okay, well, that's the same state. That's just a statement. Where are the freaking minutes? Maybe everybody's having the same problem. All right, highlights from the minutes. Oh, good. Some officials saw risk of inflation lag to target. So contrary to that statement, let's see. Some officials saw risk of inflation lagging. Voters agreed that recent strengthening of the economy increased the likelihood for gradual rate increases. Most voters said that data suggested modestly strong near-term outlook that was seen in December. Generally judged risk to be balanced, but saw increased upside risk in the near term. That means they're more inclined to tighten. Number of policymakers raised the near-term economic growth forecast because of stronger data. So that's, again, more tightening, suggesting a larger impact from the tax overhaul. A few said it's important to monitor the slope of the yield curve, and they warned of imbalances in the financial markets may emerge as the economy operates above potential. All of this is more towards tightening. So I don't see what the market would be so excited about, but it is plowing higher right now. Especially the Dow. Look at the Dow hitting 25.2. And here we're at 1555. I'm not going to add any more right now. I'm going to wait and see what happens. So now I'm down $1,000. See, that's what I said, how easy it can happen. And the NASDAQ is way up here. It went up so fast it blew the chart. There we go. So everything is flying up as if this is some fantastic news, but I don't see it being any different at all. But, you know, again, I wouldn't recommend jumping in and following me on this. I started off with a bet. The bet was wrong and went the wrong way. I'm willing to see it through. But I don't think so far it's certainly technically not looking like a good bet. So we'll see how far it can really go. I'll be interested if we come across this line. This is the second resistance line. So if it goes over that, then you got a real rally on your hands. But we'll see if it calms down or not. But I don't see anything in those minutes that indicate that anything has changed. And the market's acting like something amazing just happened. But I think it was just dying to go up. Pretty sure that's what it is. I don't think this is a real reaction. With all the short puts, how much cash do you have to hold in the account to make sure you have the purchasing power should you be assigned? It depends on the kind of account you have. If you have $100,000, you're eligible for a portfolio margin account, in which case it's not a lot. Like, you know, again, let's take Apple. All right, so with Apple, if I sell the 140 puts on Apple, so it's at 173, and I sell the 140 puts for $9. So I go here and I go sell the single 140 puts for $9. So I'm going to collect $9,000. That's for 10 contracts. I'm going to collect $9,000. It's 1,000 shares of Apple here that you're controlling. And my buying power effect, the margin, is $9,300. So in order to make $9,000 by promising to buy Apple for $140, I'm being charged $9,000 in margin. Now, the tricky thing about the margin, though, is you have to be very aware that if Apple goes lower, the margin will increase. It's not a static thing. So that margin can go higher. But it's not, if you have an IRA, they're going to charge you $175,000 to do that, to control 1,000 shares of Apple. Because an IRA, you have to put up all the margins that could be required from owning the stock. In a regular account, this isn't even a portfolio margin account. In a regular account, you only have to put up a percentage based on the adjusted risk of the thing. Usually they'll assume the stock's going to move 20%. 20% is right about 140. So there's very little margin to selling the 140 puts. If I sell, on the other hand, the 170 puts for $20, probably going to be a higher margin. Let's see. So let's say we sell the 170 puts for $20. No, not higher. So the margin is $15,000. But of course, I'm collecting $20,000. But the margin here is $15,000 in margin. But of course, it's, you know, I can get a lot more screwed on the 170s. The 140s, I have $30, 20% cushion on the stock, on the current stock price. And even if it hits 140, I collected $9 up front. I'm really at 131 is my net, is my break even on Apple. So that's why we often sell short puts to buy a stock. So when you say how much margin, basically, if you look at the long-term portfolio, which is a $500,000 portfolio, we sold, we have 12 short puts. We collected 5, 9, 10, 12, 20, 22, 30, 37, 45, 50, a little less than 60, let's say $55,000, $60,000. So we collected $60,000, and probably it's using about 60,000 in margins. Probably, but the buying power on the portfolio at 500,000 is $1 million. So we're using a very tiny amount of our margin, but it's probably about the same. Well, no, I'm sorry. In portfolio margin, it would be less, but let's say to collect $60,000, we use $60,000 in margin. We can easily afford it because all we're doing is bookmarking positions we'd like to buy if they get cheaper, and we keep a tremendous amount of cash in the portfolio. We have 400,000 in cash out of 550, so we're like 75-80% cash. Can you show on the calculator how blah blah blah? Okay. Did you adjust the SunPower trade as it fell due to tariffs? No, we did not, because we still don't know what really is happening with SunPower. Well, I say we did not, but I don't remember where it was. You know, here's where SunPower is now. In the long-term portfolio, we have 30 long $5 calls, 2020s. We have $27 puts, which I love, and we have so we have the 512. Basically, we have the 512 spread in 2020, which was net nothing really. It's still net nothing. It's 360 minus 142. So that's only 220 for the $7 spread. That's pretty damn good. So and again, it's the same thing. See, it's 220. The net of this spread is 220, and you've got a spread where if you pay 220, then you're paying 720. You've got the $5 call plus 220 you paid is 720. Stock's at 745. You're better off with that spread than owning the stock. And we offset that with these puts that we sold for 230. So guess what? We paid net zero for that spread. And what can happen to us? Well, we have no cash in the game, right? Here's 9,000 we laid out minus 46 minus 63. We actually have $1,000 credit on this thing. I'm sorry, 10. No, I'm sorry. We have $1,900 credit on these positions, and if we hit it with our spread, we have 30 of the $7 spreads. That's another $21,000. So we end up with about $22,000, $23,000 if it works out. If it doesn't work out, we're forced to buy $14,000 worth of stock, 2,000 shares at 7, but we have 2,000 cash, so that knocks like $1.50 off the price of these guys. I'm sorry, not $1.50. 30, about 60 cents off. So we would net in for $6.40. So the worst case scenario on this spread is that we net in for $6.40, and the best case scenario is at $12. We get $22,000. Is there any way to see other people's questions? Apparently not. It's a pretty stupid thing on this site, but I have to read them out. So anyway, so SunPower, the position we have now, the 512 spread is so conservative, there is no reason to adjust it. You know, we're very happy with this position. Look at Tenet Health. That's cracking up. All right, thanks for that about the Forex. That helped. Monetary policy remains accommodative. Yes. You were in the right spot, Phil. I don't know what happened. Federal Reserve monetary policy minutes. Okay, well, that ship has sailed. I'm done with that. I've lost interest in the Fed at this point, other than seeing if they keep flying higher on the market. How are we doing? Back to active trader. Oh, now it's only down $800. So we're riding that Bronco right now. Here's the Dow right at 25.2. That's a short I like. Playing the short below the 25.2 line I like. If I didn't already have this, I would certainly do that one. and we'll just see what happens. Okay. What do you make of the VIX right now? The VIX it's a crap index. We got burned on. We played SVXY. We got really burned when it crashed. Look, the VIX doesn't tell you volatility because when the market goes up, if the market goes up 1,000 points, the VIX goes down. If the market goes down 1,000 points, the VIX goes up. So it's not telling you volatility because 1,000 up and 1,000 down is the same volatility. What it's telling you is the bearish sentiment indicator. It's a single day bearish sentiment indicator. So it doesn't even do what people think it does. And it only works when it only really pays off when the market goes down, basically. So you can just as easily short the Dow and have a much better have a much more consistent bet than playing the VIX. So I don't like it. I think it's a complete waste of time. It's like it's as if somebody puts a random number generator on the casino floor and you make bets on it and you realize it's just putting up random numbers. There's no way to win. There's no way to tell. You sometimes get paid, you sometimes don't, but there's no rhyme or reason to it. Is that a game? No, it's not a game. And the VIX isn't a proper instrument. It shouldn't really exist. What package do you recommend for a newbie small fry investor? Says 3. I would suggest. I mean, if you want to view the chat room, I would suggest the Trend Watcher membership because you'll learn more. You'll read what we talk about with the high net worth investors in our chat room. You won't get to ask questions, but you will see all the chat that does go on and all the things we talk about and get an idea of what happens. Also, in Seeking Alpha, you can apply to just an options opportunity portfolio. And again, that's not really different than the Trend Watcher membership, frankly, at PSW. But at least it concentrates on that one portfolio, which is only $100,000 portfolio geared towards the smaller investors. None of this stuff is intro to options. I mean, I teach hedge fund managers how to trade. People in our site are fund managers and have tons of money, people with hundreds of millions of dollars that they're investing. So it's not an intro to options site at all. We're not geared for newbie investors in that way. We're geared towards teaching people how to really hedge and properly invest their money. And frankly, the picks are a side thing. Like, we didn't even used to track portfolios. There was a lot of demand for it from people, but we didn't even used to track portfolios because that wasn't the point. I mean, I made picks, but the picks were just sort of like, oh, well, it's an example for how you trade something. It had nothing to do with like whether I wasn't into like picking stocks, and I'm still not, frankly. It's sort of a side effect of just what we do when we teach people. People ask me about a trade and I say, I like this, I like that. I started making a watch list to say, here's 25, 30 stocks I like, but that doesn't stop people from, looking at other stocks anyway. So, what I'm really trying to do is teach people how to value companies and how to bet companies and how to play things themselves. And hopefully they come to us, which happens a lot in the member chat. They come to us with good ideas and they share with the chat room. So somebody sees something in the market and from their expertise, and a lot of the guys, we did a poll once with our members. Almost everybody in our membership has, they've either run a business themselves, or they've been very successful and high-level executives at businesses, or they're already in the financial markets and so on and so forth. So these guys know a lot about a lot of different industries, and there's rarely anything that comes up where somebody doesn't chime in and say, well, I used to be the CEO of Exxon, and I say this. So we get real expert guys chiming in on things. And so we get great opinions, we get good information, and people see fantastic opportunities way ahead of the market. That's what this is about. It's not unfortunately a learning to trade options kind of site. For that, there's like 100 sites that you can go to just learn how to trade. This is more about teaching you, like, okay, here you have a portfolio, you are investing. Here's what we're doing, and here's the way we see the market moving, and here's the kind of investments we think are relevant. 0-minute review. Okay. Comments on crude would be appreciated. It's not in a good place to bet. There's my comment. Right now, crude is not in a good place to bet. You have the forces of very low demand. Reality is low demand, plenty of oil, worldwide glut basically. And the only reason that it's even slightly imbalanced is because OPEC stopped producing it. They cut back their production. Had they not cut back their production, there would be a glut of epic proportions in crude, and it would be trading at 20. So kudos to them for cutting their production. But if they cut their production, then it's fake. There's plenty of oil. They just aren't producing it. That doesn't make there not be plenty of oil. You know, it's a funny thing. It's like let's say you have a freshwater lake that you could drink out of. Not that you should, but let's say you have a freshwater lake in your neighborhood, and you could drink right out of it, and everybody drinks out of it for free. And then one day the water company comes by and they put a big plastic cover over the lake, and they say, "Nah, you can't drink out of that anymore, and we have to raise the price of water." And you'd be like, what are you raising the price of water for? Well, because you can't drink out of the lake anymore. Like, well, you put a cover on the lake. It's not like you can't drink out of the lake. You can't drink out of it because you covered it. Okay, that's not a good reason for the price of water to go up. It's not a good reason for the price of oil to go up. The oil's there. They're just not giving it to you. That's not a shortage. So certainly it's not a shortage I would be betting on. All this is because of the Aramco thing. The Saudis are willing to lose billions, tens of billions, hundreds of billions of dollars ahead of the Aramco IPO because they're trying to take their oil company, the state oil company that owns all their oil, they're trying to take it public for $2 trillion. $2 trillion. $2 trillion. That's 3 times bigger than Apple and 4 times bigger than Exxon. They want it to be the biggest company on the planet at the IPO. And the only way they can do that is to keep oil in the 60s and 70s. Otherwise, they could never justify the price. So they are willing to do anything. And it doesn't matter if the state Saudi Arabia, if they lose $100 billion by not producing a certain amount of oil, if they cut back their oil production and have a shortfall of $100 billion, that doesn't matter in the grand scheme of things where they're trying to do a $2 trillion IPO. And why are they trying to do a $2 trillion IPO? Because they're trying to get rid of this asset before it implodes on them. So, oil it's scammed up at the moment, but there's no other reason it's high. But it's also in a very ugly place and not really worth playing in either direction. Does it make sense to buy back calls on some spreads if they make 50%, for example? Yes, it does on some, but you have to really evaluate each one. And that's the process we go through when we do our reviews each week, each month. When we do a review, we talk about each play and we say this one is running up too much or this one isn't worth it anymore. But generally, as a rule of thumb, if you want a real quick rule of thumb, if it's a 2-year spread, and so obviously if it's a 2-month spread, it would be 1 month. But if it's a 2-year spread and you're up more than 50% in the first 6 months, in 1 quarter of the time, then probably you should take it off the table because your plan was to be up 50% in the first year after 12 months. So if you're up 50% after 6 months, there's not a very good chance you're going to make the other 50%. In fact, you can't because it's a 2-year spread. You will not make 100% in the next 12 months. All you're going to do is make the rest of your 50% over 18 months. Now your rate of return is going to drop dramatically. Meanwhile, you've got the 1.5 times the money in the hand, the bird in the hand is 1.5x. And now the question is, can I make more money than that by closing this and buying something else? And if you have other opportunities that will have a better return, then yeah. So in other words, if I start out with $10,000, now I have $15,000 because I'm up 50%, and I'm going to make $5,000 more on my $15,000. That's only 33% over the next 18 months. That's only barely 20%. We can make 20% with our hands tied behind our back. So we're not very excited by making 20% for the next 2 years with us $15,000. So why would I risk my $15,000 just to make 20% anymore? Now, maybe though it was the Apple 140 puts and I'm up 50% already and I'm going to make another 50% and there's like no chance in hell I'm ever going to lose. That has to be taken into account too, though. It's only using $10,000 of margin. It's going to make $10,000, and I can't even envision a possible way that I'll lose. And in fact, frankly, even if I do lose on those, I'm going to be so happy to buy Apple $430 a share that I could care less. So, you know, so in other words, I'll be too busy mortgaging my house to buy Apple, you know, for as much as I can for that price. So you have to weigh that out too. There are certain positions that we end up leaving the long-term portfolio just because they're so safe. I'm like, why would I even pay $50 to buy that back? It's not using much margin, and I'm going to make $50. You know, even if it's a silly $50, it's like, well, I don't have a reason to close it. I've got a 1.5 million in margin sitting around doing nothing. I don't need it, so why would I close it? So all that has to be taken into account. All right, you're welcome, Sri. Then why OIH bull call spread if you're bearish on oil? Because we're selling. That's a totally different position. The OIH position is in the butterfly portfolio, and the butterfly portfolio, okay, I'm bearish on oil prices at this over 60. I'm not bearish on oil services in getting the oil out of the ground. Okay, those things are at a deep trough, and I think that they're going to hang on. And we're not bullish on OIH, but we have a bullish position. But the purpose of the bullish position on OIH, which is in the butterfly portfolio, notice it's not in long-term portfolio or the short or any of the other portfolios. It's only in the butterfly. And what do we? Where is my butterfly portfolio? Here it is. And the purpose of the butterfly portfolio, we just transitioned this, by the way. It became bullish because OIH got so cheap. But we have the $20 calls into, we haven't covered it because we're waiting for it to bounce back. We have the $20 calls in 2020. We sold the $23 puts, so that's our target for the high end. And we have also sold some March 29 puts. Why did we sell March 29 puts? Anyone? Oh, I see. They're left over, so we're going to roll those. So the point is, and we already brought back the short call. So we have the March 29 puts that are, well, it doesn't matter what they are. We sold them for $1. So what was that? OIH? All right. So in OIH, we sold the March 29 puts. We also sold calls, but let's say we sold the puts for $1. We probably sold the calls for $1. So let's say we sold these for $2. Now they're $4.80. We're going to roll them to, let's say, the July 26 calls at $2.72. Not now, but when it gets closer, because we still think it'll pop up between now and then. But let's say we roll them down here to $2.62. Now we sold them for $1. They're now $4 something, 470. They're now $4.72, so they're $4.70. We sold them for $1. They're $4.70. So if we roll to something that's $3.30, $3.40, like these guys are $3.50, and let's say we roll them to the 25s, though. Let's say we roll them to the 26s at $2.80. That's $3.80. So we're going to have that, and then we're also going to sell some calls. And let's say, for example, we sell the 25 calls for $1.50. So then we've collected another $1.50, so that's $2.50, plus the money we sell these guys for, which is $2.70. So we've collected $5.70 on this position, and all we have to do is have this one expire worthless, and we make the $5.70. And meanwhile, we have 2 more years to do rolls like that. Now, the long position cost us, we put net 96 minus 3 minus 1, so about $5,000 into it. So we put about $5,000 into it, and we sold, and we're playing with $5,000 worth of short puts and calls. Now, if at any time those expire worthless, then the net of our position becomes 0, and from that point forward, all put and call sales we make become profit. Not only that becomes profit, but anything OIH above 20 becomes profit. So if it finishes at 25, we make $7,500 plus whatever we make selling puts and calls along the way. That's how the butterfly portfolio works. It's all about consistently selling premium over time. And so the reason we flip bullish on OIH is, and by the way, we're down in the portfolio, but the reason we flip bullish is because this position went down a lot, and we feel that OIH is worth much more than it is now. So we changed the position from a neutral position, OIH. We had a neutral position at about 29 or 27 or wherever it was, But we had a neutral position where we didn't care what happened to it there, and now it's dropped. By the way, we had the long puts that we cashed in also for a profit, so we're probably in that position for less than $9,000, for less than $5,000. But all we're saying though is we control the position, and along the way we can sell $2,000 worth of puts and calls every couple of months. So if I get in a position for $5,000 and every 2 months for 20 months, I can sell $2,000 worth of puts and calls. I can sell $20,000 worth of premium against my $5,000 long position. So the bet is that it finishes over 20. That becomes my bonus money. But meanwhile, as long as it finishes in a range where my puts and calls expire worthless, I'm going to start collecting all that money. And that's what the butterfly portfolio is about. It's not about a bullish or bearish or whatever. We will take a stand when something gets ridiculously cheap. But our goal isn't really to even win these positions in the long term. Our goal is to sell the premium along the way. And we do a lot of that in the hedge fund because it's by far the most consistent way to make money. In your opinion, is a natural gas pipeline like the EPD a good long-term bet for a retired person? I think it's, well, you got to be careful. You say it, but you say like EPD. I don't know what EPD does. Some of these things you have to be very careful because they're run like a REIT, but they wind down. EPD. So you have to be very careful to study them and understand how their business works, because sometimes they wind down their assets on you and you get really screwed. Like it becomes less and less valuable as time goes on. But EPD is a big one, and they're probably run like a more normal company. They're not really a pipeline company. I mean, they have a lot of pipelines, but they're a transmission company, storage, all sorts of stuff they're into. It's not just a pipeline. It's a good company, though. It's got a solid base. They got $23 billion in revenues, but look how that revenue. See, they do have a lot of, a massive decline in revenues. 12, 24. So they're really not improving. They've got this massively declining revenue. So don't start thinking they're worth much more than what they are now. They're making $3 billion a year, $2.5 billion net, and they're charging you $50 billion for the company. So you're paying 20 times earnings. That's a lot for a transmission company. Usually they trade like 15 PEs, and you're paying 20. So you're paying a pretty penny for these kind of guys. They do have a nice dividend. So I'm saying it's not a terrible thing. There may be better ones out there. I don't know. I haven't really looked at this thing. Kinder Morgan is one we used to play, but they've been falling apart also. So I kind of lost interest in all these guys. And also with LNG, you have to worry about a real disruption coming to that marketplace, because they've got these pipes that are not suitable to transmit LNG. I mean, it's funny because they say pipeline, and I think people have this image of this big fat pipe. It's like some massive thing, whatever. It turns out they're like, it looks like PVC. A lot of the pipelines you see, they look like PVC plumbing pipes, like just plastic sort of things going across the landscape. They're not even metal. And so they're not really made to stand up to the pressure and such of what an LNG is going to be. Now, since LNG is becoming a thing, right now the gas is transmitted from the place of extraction over these pipelines, over these very flimsy sort of pipeline networks, and they go to a hub, and then at the hub they're compressed and then put on ships. Now, there may come a time when the compression is done on site, and God forbid that happens, all these pipelines begin to become worthless, because if you compress on site and transmit it by train, which I frankly wouldn't want to be anywhere near that train, but if you compress the LNG on site and put it on train, you will save a ton of money in transmission costs. You'll save time, because you're compressing it 600 times. The pipes aren't that fast. 600 times means basically a 6-day supply of gas can be put on a truck. Not a 6-day, I'm sorry. A 600-day supply of gas can be put on a truck and sent. So your entire year's gas supply can be shipped out on a truck, basically, compared to every day pumping a little bit into the pipeline, blah, blah, blah. So I worry that whole business can get disrupted. Now there's environmental concerns and so on and so forth. But you know what I think would be cool is Elon Musk with his Hyperloop, right? If you had from a shale spot like Marcellus, if you built an underground pipeline, and I don't know where you do it, you'd have to have a clear. You'd have a lot of trouble, obviously, going past people's houses. But if you could shoot LNG in those Hyperloop kind of tubes, maybe in smaller amounts and maybe in smaller tubes, but if the people at the site compress their natural gas into LNG canisters, fire those canisters over like a Hyperloop, sort of like a vacuum tubey thing, and shoot them along to the destinations, you would blow away the trains, you would blow away the pipelines and the rails and everything else, and you'd basically be on-demand LNG anywhere you wanted to send it. So I see the whole thing as being ripe for disruption. So I don't hate the business, but I don't think I'd want to wrap my retirement around it or something like that. That's the thing. I think long term they may have some issues. All right, let's see how my money's doing. Where are we? Chart, active trader. Oh, pulling back a little bit. Look at that. See, that's what we do it for. So we're back at 8. You were back at 1550. Remember, I wanted to be an average of 1550, but I didn't want to be at 4. I wanted to be at 2. So as we come back to 1550, I'm now going to buy right here 1. Oh, even going to get a better price. Come on. Oh, look at that. 2. Nope. Ah. Oh, come on. Oh. Damn it. I was so happy. There we go. Come on, one more. No. Come on, baby. You can do it. See, 2740 is holding. That's not good. One more. Come on. Ah! You are kidding me, bastard. Ugh. Now I'm giving until 1551. I'm going to give up. See, he popped way up to 41. I should get out. All right. Be happy. So now I'm down $90 for the day. Remember, I was down like 1,000 something. So now I'm down $90. My average is, ignore that now. It's all screwed up. But the average is now right about 1550.5. And now I'm exactly where I want it to be. So remember, we started shorting at 1545. I doubled down and doubled down again. I brought my average up to 1550. And now I'm back down to 2, the original amount that I wanted to be at the strike I wanted to be. So that's what I mean by playing with conviction. I'm adding to it on the way up, but with the intention of reducing it as soon as I get my pullback, so that I now have the 2 I was willing to sleep on overnight. So now I'm 2 short on the Russell at 1550.5. And if you do it now, you're going to get a better price than I am, because it's a point higher than that now. I would not now add to it unless I can get up to more like 15, back at 1555. I really don't have any interest in adding to it now. But at 1555, if I do it again, I'll bring my average up to 1552.50. So that would be my next goal. Meanwhile, 25.2 failed. This guy, I wouldn't call that a failure. These guys this is rocking up here. 27.40 is the next line you want to watch. But on the whole, just technically, this is a constructive day. We made the levels that we were looking for to show that we were making progress. We talked about that this morning in the post. See, 27.28 is a strong bounce line on the S&P. So basically, once you're over the strong bounce line, you only have to hold it for 2 days without going under, and then it's firm. Now, we haven't actually held it for 1 day without going under yet, because the S&P was under it this morning. So we haven't actually held it for 2 days, but you have to at least close today above that line and hold it through tomorrow. Then you can say it's bullish, and then you'd have to take off any kind of bearish bets. But as it stands now, I still feel that we could have a more of a pullback. And I think that until it proves it, then I'm willing to have my short out and see what happens. Because I got a feeling we could have another crushingly low day. All right, where were we? Were we looking at the portfolios or something? I remember. I think we were talking about the long-term portfolio. So now it's up 12%. Wow, this thing's chugging along. You just keep throwing money at us. So I got nothing to say. So we talked about these positions. So in the review, you can go over all the positions, and we went over them one by one. But they're just good, solid positions, and they're all mostly based on a bull call spread with a short put, because it's my favorite way to play something. The only stock we own here is Ford and now SunPower. We added. Oh, and Frontier. And I wish we had bought more Frontier, but we didn't. We bought 715. We bought 2,500 shares, but that's nothing. But these guys pay such a huge dividend, and they seem to be continuing to pay it. And then, of course, the options opportunity portfolio, that's up 1.6% now, so it turned around nicely. And that one also has Frontier, which I love. We have the SQQ spread as a hedge. This is self-hedging. Oh, that's right, because in the long-term portfolio, it's hedged by the short-term portfolio. The short-term portfolio is now at 22%, because we did make a little bit of money on that little dip with the hedges. We would have been up way higher than this, but we got screwed on that SQQ thing. Not SQQ, SVXY, right, on the VIX. So we got eaten on the VIX, and that probably chewed up about half of our profits. So here we have 22.8% return, so we're up $22,000. This is a paired portfolio with the long-term portfolio. And what happens, ideally, when the long-term portfolio makes money, the short-term portfolio loses money because it's hedging the long-term portfolio. But when we get a sharp pullback like we had, and we decided to cash out our short positions, we cashed them out. When it bounced back, now we're back to being covered again. But when we cashed out at just the right time. We caught a great bounce, and it dropped a lot of cash into the portfolio. So that's why we have a double win. So we're up 22,000 here, and we're up 50,000 in the long-term portfolio as well. The options opportunity portfolio, on the other hand, is self-hedging, so it doesn't have that. And also we don't have the margin. It's only a $100,000 portfolio. We don't have the margin to mess around with it. So we don't do what we do with the short-term portfolio. We don't rip, we don't tear our hedges apart and cash them in when there's a quick dip. So we don't make the extra money like we do in the short-term, long-term portfolio. You just need more margin. Now, later on, though, when we have more margin, as this portfolio grows and it gets to be 250,000, then we'll have the margin to mess around with. But right now we don't, so we don't make those kind of plays. Here we also have Northern Dynasty, who are back to $1.07. That's another stock we hold. But on the whole, it's just a good bunch of stocks, and they're in good shape, and we have our hedges internal. So we're not worried about going up, and we're not worried about going down in this portfolio, which is very good. All right, so I'm going to have to wrap this thing up. We're almost at 3 o'clock. Let me see. Is there anything else important to talk about? Talked about that. And like I said, when we do our reviews, we talk about each position. We decide where we are. In fact, gee, another one. I'm simply bored banging the table on. Put it under your pillow and check on it in July 2019. That's my comment on GE. Don't even look at it. Stop talking about it. Just own it and walk away for 18 months. That's my basic plan with GE. I don't care what it does between now and the end of the year, and I don't even care what it does at the beginning of next year. I care about next summer. Tell me where it is, then we'll talk. But I don't expect this thing to do anything now. If it does, it's just a bonus. Okay, 3S. Can you suggest any rule of thumb for rolling positions? How far ahead do you do it or price? Well, then again, it all depends. It's again, we'll go back to this. This is why we do this. We look and we evaluate every trade every time. See HMNY? I said, let's just shut this position down. Now, instead of rolling, this is rolling really though. I said, let's just shut this thing down. And now we shut down that position. We initiated a new position at different strikes. That's rolling. It's no different than rolling. We decided to do it. I didn't like the position anymore. We decided to move it. The rule of thumb is if you can do better, there is one rule of thumb I have. Unless I don't like a stock anymore, if I can roll down $5 in strike for 250 or less, I'll tend to do that. If I can go 250 more in the money, I'm sorry, if I can go $5 more in the money for 250, I will do that. So if I can roll it, if I have a $20 call and I can roll it to the $15 call for 250, and the stock has to be above where I'm rolling. It has to be higher than, it would not even, you know, if I'm rolling to the 15, it would have to be at least at 1750, because I'd be rolling from being out of the money to rolling to be in the money. So I'm only spending the 250 that I'm going in the money for. But whenever I have a situation like that, I will tend to make that roll, because it gives you way better leverage. And so obviously, if I don't like the stock enough to put, more money into it to roll it, in other words, who did we roll? HMNY. Well, FKT, we bought the stock. I wish I could say this. Be my last thing for the day. All right. So, going down again. Yay. All right. Anyway, see, I get really excited when I make $100. I don't know. It's still fun. Let's see. So let's say Apple, right? So if I have the Apple 160 calls, they are $33, let's say. These guys are $38. They're a little more, actually, so I wouldn't do the, but anyway, the 160 calls are $33. The 150 calls are $39 or $38. Sorry, I'm saying 30. If they're 39, I won't do it. If they're 38, I'll strongly consider it, because what am I doing? Apple is at 170. If I roll from the 160s to the 150s, I'm picking up $10 in strike for $5. Why would I not do that? It doesn't make sense not to. They're going to give me $10 for $5. Now, logically, I have to think about why I wouldn't want to do that. Well, I'm taking more risk. I'm putting $5 more into the trade. So unless I feel very strongly that Apple is going to go low, unless I feel strongly it's going to go higher, why am I putting $5 more into it? But if Apple had a pullback for a stupid reason, and I get a good opportunity to make a roll like that, and I think that reason is going to erase and it hasn't changed my long-term view on Apple, and my target is still $200, then of course I'm going to make that roll. Why would I not? It doesn't make sense. If I like the stock, how can I not make that roll? Frankly, if I sit there and I don't make that roll, I have to really question my whole premise on the stock. I'm like, do I actually like Apple? How could I say I like it and not be willing to put $5 more into it to roll it $10 lower? How can I really believe it's going to be at 200 if I'm too scared to make 100% on my investment? I'm going to invest $5. I'm going to get back $10 in 2 years. That's a fact, unless Apple is below that price. So if I don't believe in it enough to make 100%, I must have a problem, and I have to start thinking deeper about what I really think about Apple. So that's how I look at the positions. I look at them very carefully, and I decide all the time, like, okay, can we make the strike better? Now, sometimes I'll say, okay, you know what, we have a great position, and it's not going to get that much. It's making it a little bit greater. I'd rather diversify than put more money into the same position. That's valid. So there's a lot of ifs, ands, and buts about it. It depends how much money you're putting in, what it's going to cost, what else you could do with the money. It's always about what else you could do with the money. Do I have anything better to do with, let's say, $10,000 if I'm doing $25 rolls? That's $10,000. Do I have something better to do with $10,000 than put it into Apple to make $10,000 in 2 years? Probably not. But that would be the question I ask myself. All right, now we're done. All right, guys. Anybody else got a question? No? Fantastic. I've answered all the questions. I am done for the day. We will do it again next week. Yeah, it'll probably be on the regular day next week. All right, stay tuned. We might move it to Thursday next week, because I'm going to be at the New York Traders Expo on Sunday morning. You guys can come see this thing live. I'll be there from 9 o'clock until 1 o'clock. I'm doing a seminar to open the show. Yeah, so I'm doing a seminar next Sunday. Not next Sunday. This Sunday in a few days. I'm doing a seminar, which I'm totally not ready for yet. And I'm going to be doing basically this with charts and graphs and teaching and showing people how to do everything and showing trades. And we're going to go over a lot of good trade ideas also. That's 9 to 1 on Sunday at the New York Traders Expo at the Marriott Marquis. And there's sign-up information on our main page. But then after that, Monday I'll be at the Traders Expo. They have me doing another class that day. And Tuesday, I think I get to go home, but I'm not sure. And so by Tuesday, I'll decide whether or not I want to do a webinar Wednesday. I might be all like exhausted and talked out and put it off till Thursday. But we'll still have a webinar next week. All right. So thanks everybody for coming. I love it. And I'll talk to you guys next week. All right. Thanks.